Your savings account just lost $18 per month in interest. Same amount sitting there. Same bank, different payout. Most people don't notice because $18 is invisible. But that's only this month. Over 12 months, that's $216 gone. Over 5 years, $1,080 your bank just didn't pay you. Here's the bit they're not telling you though. While your savings rate dropped by 0.5%, one entire investment class just became 30% cheaper to buy into. That's not theory. That's market data from the last 3 months. And if you're under 35, putting money anywhere except a savings account right now, you're making a decision that'll compound for the next 3 decades. The average Australian has $8,400 sitting in a savings account, earning 3.85% right now. That's $27.23 per month in interest. 2 years ago, with rates at their peak, that same $8,400 was earning $47 per month. That's a $19.77 monthly gap. For someone with $50,000 in savings, that's a $116 per month difference. But look, here's where it gets interesting. When rates drop, bond prices go up. That's not an opinion, that's how bonds work. The average Australian has never bought a bond in their life, so nobody talks about this. A bond that was worth $980 last month is now worth $1,274. That's a $294 swing on a single $1,000 bond. And the yield on that bond, still locked in. You're getting paid to hold something that just became cheaper to buy. Dividend stocks work similarly. Companies that pay dividends saw their share prices compress when rates were high because investors could get 5% risk-free in a savings account. Now that you can't, those shares just became more attractive. The ASX 200 yield is now averaging 4.2% across dividend-paying stocks. That's up from 3.1% 18 months ago, but the share prices are lower. You're getting more income from the same dollar invested. Here's the exact dollar impact if you're thinking about this wrong. Someone earning $85,000 per year puts $500 per month into a high-interest savings account earning 3.85%. In 12 months, they've got $6,000 plus $116 in interest. That's $6,116. Over 5 years at that rate, they're at $30,870. Over 10 years, $62,100. Same person. Same $500 per month, same income. But they split it instead. They keep $200 per month in the savings account earning 3.85%, which is $2,400 over 12 months plus $46 in interest. And they invest $300 per month into a diversified portfolio of Australian dividend stocks and a bond ETF, averaging 5.2% annual return. After 12 months, that $3,600 plus $156 in growth is now $3,756. Over 5 years, that investment side is $21,450 instead of staying at $15,000 in savings. That's a $6,450 difference. Over 10 years at 5.2%, that $300 per month becomes $49,680 instead of $31,050 in savings. That's an $18,630 gap. Same person, same spending, different math, but the timing bit is real. When rates stabilize or go back up, bond prices fall and dividend stock prices typically rise because of the valuation shift. You're buying at what's genuinely better value right now than you will be in 12 months if rates tick up again. That's not me talking, that's how markets have moved for the last 40 years whenever we've seen rate cycles. The specific cuts you can make to your savings right now are straightforward. Cut 1 is your savings account rate lock. If you're still in a major bank account earning 2.1%, switch to an online bank earning 4.25% per month. That's $330 per month per $100,000 in savings that you're leaving on the table. Actually, technically we're talking about $39.60 per month on $100,000, but the point stands right. Stop letting inertia cost you money. Cut 2 is eliminating a subscription you're not using. That's genuinely $18 per month for someone still paying for a gym membership they stopped visiting in March. That money goes straight into your investment account. Cut 3 is switching your insurance. The average Australian can save $240 per year on car insurance by getting 3 quotes. That's $20 per month if you split it across the year. Into the investment account. Cut 4 is your coffee spend. I'm not going to tell you to quit it, but genuinely dropping from 5 coffees a week to 3 is $32 per month redirected. This is boring, but it works. Cut 5 is your streaming services. You're probably paying for Netflix, Disney Plus, and one thing you forgot about, that's $38 per month. Keep 1, cut the other 2, that's $130 per month now available. The additions are where the real leverage shows up. Addition 1 is setting up an automatic transfer to a brokerage account on your payday. That same $300 per month we talked about, but it happens automatically so you don't think about it. You don't have the option to spend it. Into a diversified ETF, it compounds at 5.2% annually. Addition 2 is moving your emergency fund thinking. Instead of keeping $15,000 in savings earning 3.85%, you keep 3 months of expenses there, let's say $9,000 for the average Australian household, and you move the extra $6,000 into a bond ETF earning 4.8%. That's $24 per month in additional income on money you're not touching anyway. Over 5 years, that's an extra $1,440 just sitting there earning more. Addition 3 is getting your employer contribution right. If your employer offers a salary sacrifice super contribution match and you're not maxing it out, you're turning down free money. That's genuinely someone offering you $50 per month to take it. Over 30 years at 6% return, that $50 per month becomes $76,680. Free, just from changing a form. Your monthly improvement is now $130 in cuts plus $74 in additional income from better allocation. That's $204 per month better off than you were 3 weeks ago. Same income, same hours worked, different decision. $204 per month over 10 years at 5.2% becomes $35,210. That's how long-term wealth actually works. Not getting rich quick, getting methodically richer every month. The 90-day snowball here is genuinely interesting. In the first month you implement cuts 1 and 2, you set up the automatic transfer of $300, and you shift $6,000 from savings. By day 90, you've got $900 invested, your emergency funds earning more, and you've locked in a better savings rate. That's $4,788 in ground covered in 1 quarter. Most people don't do anything in a quarter. Here's what's actually changed since rates dropped. You can build wealth faster right now because asset prices are lower and your returns are going up. The window doesn't stay open forever. When rates stabilize, bond prices will fall and dividend valuations will shift. You're not too late, but you're also not going to get this timing twice. Open a brokerage account this week. The Perla or Stake or ComSec Pocket let you start with $100. Pick a diversified ETF with Australian dividend stocks or mix in an international one like VAS and VGS. Set up the automatic transfer. Honestly, that's it. You're doing the move most Australians won't do for another 2 years, and by then they'll have missed $24,480 in growth on this exact amount. The banks are counting on you to do nothing because confusion is profitable for them. Don't be that person.